Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Today, we have a very special guest, one of our own GW Investment Institute Advisory Board members, Mr. John Roberts. Mr. Roberts, thank you for being on Market News with Rodney Lake. Very much appreciated.
Always good to be back on campus where I started this thing.
Exactly. Well, I mentioned you're an alumnus from the business school in particular, and I want to start out with a thank you. So you actually spoke at commencement earlier this year in May to our undergrad business school students and imparted some great wisdom, which I know they all remember at this point already. But I want to just say thank you for doing that. That's a big responsibility to take on, and we're appreciative that you stepped into that role and did that. So thank you for doing that.
Well, it was a huge honor, and as I've said many a time, it's just we all have to give back, and it's just it's been great to spend some time here on campus and see the school, see how well it's doing, and I always get kind of invigorated talking to the students and seeing the younger generation and coming out of the business school and seeing their successes, and it's great.
Great. Well, thank you. And then also thanks for doing a guest lecture later today. So let's maybe get into your background a little bit. So right now, I'm going to give the where you are now, but could you start us out maybe at the origin story at GW and work our way to the present? So right now, you're a senior portfolio manager at Corient. Corient manages about $185 billion as of 9/30/2024. So a very substantial, big firm asset manager. You're a portfolio manager there. But let's start with GW. So you're at GW. What are you studying? And let us know a little bit about your origin story.
Sure. My origin, I was a Navy brat, so I grew up all over the world. Kind of colors my view of things. Born in Japan, grew up mostly Southeast Asia. Ended up in Northern California, middle school, high school. Moved out to DC for college. It was 3,000 miles away. It was a nice road trip. But really was fell in love with the business school and finance, and had some different internships while I was here, accounting for a government contractor, which was fascinating. And when I graduated, I followed a lot of the path of a lot of people, and went on to Wall Street working for an investment bank, Payne Weber at the time, which is subsequently got acquired by UBS. Did that for a number of years. Thought I wanted to go become a lawyer, so I went to law school. Didn't end up becoming a lawyer. Passed the bar, and went ahead and finished, and went right back into the investment management business.
Excellent.
Started with a firm called Denver Investments out of Denver, institutional RIA, and we grew it. Merged with another firm out of Chicago, Siegel Bryant Hamel, in about 2018. And a few years later, we did the transaction where we sold to Corient. So I've been lucky in that every firm I've ever worked at has been acquired.
Nice.
So one of the morals of the story is have equity.
Well, I think that's a good lesson.
And so that's but the last since I started at predecessor firm Denver Investments in '96 out of law school, worn a lot of hats, and done everything from launching one of the nation's first ETFs that focused on workplace equality, creating the index around that. So know about ETF structure. I've been a co-portfolio manager on open-ended mutual funds that the firm ran. So and managed portfolios for foundations, families, individuals, endowments, more recently with the merger we did with Siegel Bryant Hamel, got access to and invested in private equity that we managed our own private labeled private equity funds. So I've seen a lot of different areas. Obviously managing money for large families and wealthy individuals. Municipal bonds are a big portion of that, starting from my get-go in California. So I know municipal bond trading pretty well. I've worked on trading desks. So I've seen a lot of the industry. Master of nothing, but I've seen a lot, a lot of different areas. Makes you a good investor then. Yeah. So that's kind of where I am now.
Excellent. All right. So I want to put a pin in where we are now and we'll come back to that. and you possibly might want to add some disclaimers as we go along here
Yes.
Before we start talking about some current market information. But before we get there, let's back up to GW. Can you give us any stories or a story about a class or anything that really stood out from your time at GW?
Lots of things. Again, the business school at the time was housed in the Hall of Government, ironically, but had some great professors. Fall of 1987, taking a portfolio management class, Black Monday, right? So it was a good kind of teaching moment for the teacher. We were discussing Burton Malkiel's A Random Walk Down Wall Street, which was one of the assigned readings. And, professor comes in, says, market's crashing. Well, what do you do? And he said, nothing.
Nice. Good advice.
Right. And if you're a long-term investor, buy. And so, you file that one back there. Between, classes like that, again, heavy on the accounting side, which gave me some great internships doing some accounting. And then, one of my favorite professors, Bill Handorf, who's still here. We just celebrated his
anniversary here.
Anniversary, recently. It was great to be part of that. Taught everyone in the class how to use the Hewlett Packard 12C. I think at
critical
the time,
device.
Yeah, I think at the time he said, "Buy this calculator or you'll flunk the class." In so many words. And so when I got to Wall Street, I knew how to make numbers spin on that thing.
Right.
We learned that calculator inside and out, and so it was a way for me to quickly calculate bond prices, discounts, premiums, what yield should be on securities. And really, you got to remember, this is pre-computer days, right? No one had laptops.
You didn't have Excel, right?
We didn't have, Excel was out there. We used it a little bit
but not in the same way it is
not in the same way
now,
today. It was very, very
rudimentary, probably.
Yeah.
Versus now.
Lotus 123 was actually the better spreadsheet at the time. So I was able to come up with numbers very quickly.
Yeah.
That the people ahead of me, my bosses, could actually use.
Nice.
And so that kind of, was always one of my, tips that I always tell younger people: find a way to make your boss look good to their boss, right? Become an invaluable member of your team. And that's a great key to success. So, thank you, Professor Handorf, for that. And I still use my same 12C that I bought in college. Tells you how well they used to make stuff.
Yeah, that's pretty good. Maybe a different battery, but that's it. Well, I think that's a great story. That's great advice. Have some tangible skills. Make yourself stand out. Make sure that you can make your bosses and their bosses look good. Those are all fantastic lessons. Now, maybe you put a disclaimer in here before we get into some market data, but maybe give us some views on the current markets right now and your thoughts on that.
Yeah. Well, first of all, as they always say, past performance is no indicator of future returns, no guarantee. All the views here are my own personal views. I am not representing Siegel Bryan Hamel Asset Management, Corient, my employers. So this is, in no way a reflection of our firm's views. This is my personal views. So
excellent. Well, thank
disclaim
you.
it.
With that out there,
yep.
Obviously the markets have been good year to date so far. So we're in early November. What are your thoughts on where we are right now with the markets broadly?
Yeah. Best election year returns ever.
Nice.
For the equity markets. Yeah. Best election year returns.
Interesting.
In the history of the equity markets in this country. So, and anytime you see best returns, it always, clearly if you look at any, kind of valuation metric, PE ratios, forward PE ratios for the S&P 500, stocks are expensive. It's kind of hard to, make a case that they're not. Obviously, .com bubble, you saw, PEs, in the north into the 20s, 20 times earnings. And right now, I think S&P 500 forward earnings, 20, 22, 20, in that area, still expensive.
Right.
And so, one thing I've learned in my 35 years of doing this is that, the laws of gravity, still exert themselves. Yeah. Especially, the gravity may be higher interest rates.
Yeah.
Right. Because, we've had 40 years of falling interest rates in this country. And I like to say that 40 years of falling interest rates soothed over a myriad of financial sins,
Right.
because you could just simply refinance your debt. If you bought too big a house and your mortgage payments were too big, you just refi.
Right.
And same thing for corporate America. And that's changed. We're facing a world of higher interest rates, no longer, continuously declining interest rates, which benefited a lot of segments of the market. Propped up asset values, some may say artificially, with
right.
the Federal Reserve ballooning its balance sheet, which begs the question: how do they undo it? And probably can't.
The so-called quantitative easing.
And quantitative easing, it's artificially lowering interest rates by buying longer dated securities, and we're not the only central bank
who does this sort of thing.
Did that.
Right,
The Japanese kind of pioneered it, and the effectiveness of it remains in question.
Right. It certainly seems to work in the short and medium terms for the desired outcome.
Absolutely.
Long-term impacts.
And it if you're an owner of assets, look, we've all benefited. My career on Wall Street, started with a 10-year treasury yielding above 10%. Right. And it got down to essentially zero.
Yeah. That's a good run.
That's a great run if you own assets. But if you don't own assets, it's not so great. And we've seen that with if you look at, kind of annual average wage growth was fairly anemic for decades, until pandemic, and you saw wage growth spike and when unemployment, collapsed and we don't have enough workers. So, there are questions about, all right, what's the feasibility of removing millions of workers when we don't have enough workers? And what does that do? And so, there might, can the Federal Reserve, are they going to lower rates? And what do they do is this another repeat of 80-82, where you had the Fed raise rates to combat inflation when Volcker got appointed and really raise rates?
Right. Very aggressive. Nothing very like
aggressively.
Now.
I remember hearing a speech years ago from somebody who worked at the New York Fed, and he talked about, he went out to lunch and he came back and they had one of those little felt boards with the plastic numbers that had the Fed funds rate, and the Fed funds rate had gone up 1.5 points over lunch, right? I mean,
expensive lunch.
I mean, that's kind of
how quickly things were changing.
Aggressive monetary, policy. But and the question is, is the Fed going to be guilty of that same thing, where the Fed raised rates in 80, induced a recession, they started lowering rates, inflation came roaring back, and they had to raise rates even faster and harder, and they induced a second recession, that double dip 80-82 recession. And if you look at the Fed notes, they talk about that, and they've mentioned it quite a bit. But given what some of the policy pronouncements of both candidates have been, many of them very inflationary, and so it does beg the question: is the Fed kind of looking forward? And I think one of the things that we've seen, and lots of people will talk about the Fed doing a great job, and especially in 2008, helicopter Ben Bernanke just quantitative
dropping money,
dropping money, and at the time it seemed like the way to put off a depression, but you have to reverse that, and the if we have higher inflation and the Fed turns around and has to start raising rates, that's no one wants that, and the Fed doesn't want it, but it almost seems like they're setting themselves up for that.
And without making a grand prediction, what is your outlook on inflation? Do you think it's under wraps? Do you think it's something that we just need to monitor? Or you think it's in alarm territory, or where are we?
Look, predictions are especially hard, especially when they're about the future. And so with that caveat, I mean, it's hard to see how we do away with inflation.
Mm-hmm.
I mean, inflation is coming from a lot of places, and it seems like inflation has come back down quite a bit, but there are headwinds. I was recently in Europe. Spent a few weeks in Europe on vacation, and meeting with some friends in Switzerland, and they ask about the election, and again, my caveat is Wall Street doesn't care about DC, right? Wall Street cares about profits,
right? They care about Wall Street.
Yeah, they care about Wall Street, and I've been doing this long enough. I've seen great returns from Democratic administrations, great returns from Republican administration, lousy returns from Republican and Democratic administrations. So Wall Street cares about profits. And but asking these friends, people in Europe, talking to them, and a lot of the comments were, it doesn't matter who wins,
Interesting.
which is,
Yeah.
you often have to look from another prism,
Right.
back at yourself. And I said, doesn't matter, because America under either candidate will withdraw from the world.
Yeah.
We're kind of, undergoing one of these impulses where we become more protectionist. And if we start enacting more trade barriers, then that tends to be inflationary,
Right.
historically. So time will tell, but it's kind of hard to say, well, inflation's
Through the system
we're
at this
done with
point.
it.
Yeah.
We'll see.
Got it. So there's another topic that everyone's talking about right now. It's artificial intelligence. And I'm sure you have some views on that. Would you mind sharing some views around, what do you think about, artificial intelligence and the impact on the market, impact on jobs, and broadly, maybe something that we're not thinking about that's relevant?
Yeah, I'm a bit of a Luddite, and while I grew up and had a computer, I had the first Macintosh when I went off to college.
Nice.
Thing was like a suitcase,
Yeah.
but I had Excel, and so I went to middle school and high school in Silicon Valley. So our high school in the early '80s had a computer lab.
Nice.
A networked computer lab donated by one of the parents who was like the manufacturing chief at Apple. So we had, all these Apple II computers. We all learned
That's
basic.
fantastic. Yeah.
So I, kind of at the cusp of the computer generation, and I consider myself, for somebody who's 58, fairly technologically savvy. But one of the things that shocks me is the time at which decisions are made. It used to be, when I started in this business, company would release earnings. It would take the market a few days to digest it.
Yeah.
Research reports got written. Investors Business Daily and Wall Street Journal the next day reported it. But it would take time for the stocks to react. And today, it's usually an overreaction.
Right, one way or
the
the
second
other.
it happens. And a lot of that is algorithm trading. A lot of it's shoot first, ask questions later.
Right.
And so I think there is something to be said about thinking about it.
Right.
Right. Slow your thinking down.
Something being
People
more
have written
deliberative.
about that.
Right.
Be deliberative. Think about it. Don't just act. Because your investment time horizon is not measured in milliseconds or days or minutes or presidential election cycles.
Right.
Right. It's measured, if you're a asset manager for an institution, you have liabilities out there. If it's a nonprofit, that essentially your time frame is perpetuity.
Right.
So it doesn't matter if you buy the stock today, tomorrow, or next week. I mean, if you've done your homework, your time horizon is a lot longer. And so
Right.
not succumbing to knee-jerk reactions, I think, is a really important thing. And unfortunately, I think as we become more reliant on AI, and there are some fantastic applications of it, obviously. Right. But like any new technology, I look back to the .com bubble, and it was going to change everything, and there will be winners and losers. But you go back to some of those stocks that were the leaders in 1998, 99, and a lot of them aren't even in business anymore.
Right.
They've gone bankrupt or gotten acquired and merged out of existence. So there's always going to be winners and losers, and trying to predict the winners and losers is devilishly impossible.
Right.
And so, yes, AI is, large language learning models. They're only as good as what you put into them. And so if they're scraping the entire internet, what's out on the
There's
internet?
a lot of stuff.
I'll just ask that question. What's out there? Right. And so we always talk about models, garbage in, garbage out.
Right.
And we'll see.
Yeah.
Well,
I
I think there are some great applications of it. I think there's also a lot of hype.
Yeah.
And with every new technology, new, investment craze, and Wall Street is fantastically good at creating new vehicles to earn fees.
Yeah.
And sell to the general public. We'll see.
Got it. Well, before we move on from the market segment here, could you maybe just wrap us up? Any outlook on the overall equity or fixed income markets? Let's take a long-term time horizon. What's the outlook for you for the next, let's say, 5, 10, and beyond years? And as investors, how should we think about, the world? Should we be optimistic? Should we be pessimistic? Should we just be doing our work and really trying to understand a certain element of the market? Just curious your thoughts there.
My 5-10 year outlook is retirement, so so it's pretty rosy.
Yeah.
I think there are always good companies that are undervalued.
Mhm.
There are always bad companies that are overvalued, and so really, doing the work.
Yeah.
There is no substitute for hard work. There's no substitute for understanding what it is you're owning.
Yeah.
I always like to say, we can't do a good job predicting, interest rates or, when a business cycle changes or, earnings quarter to quarter. But, if you find good companies that are managed by, competent management teams that have a good moat around their product or their services, that whatever they're selling, you want to, hitch your horse to that wagon. Right. I think the last few decades have shown us, that even the best of companies, if they're mismanaged, if you're an owner of the stock, you're in trouble.
Right.
So, the time, I don't have the specific data in front of me, but the time companies spend in the S&P 500 has been shrinking.
Yeah.
Right. And so it's that, the creative destruction that is so much a theme of capitalism, right? Tocqueville decried that. In America they let companies go out of business.
Yeah.
Hundreds of years ago. It's still true,
Yeah.
right? There's no substitute for failure. Now in this country we kind of celebrate that. We say, look, you tried,
Right.
right? In a lot of cultures, failure is
Unacceptable.
time to fall on the sword,
Right.
But look, you get back up, you try again, and so. You just don't want to be an investor in that company that fails.
Right. You want to miss that one.
You want to miss that.
Yeah.
And so, long term, I think you have to be an optimist to be in this business.
Yeah.
Because if you're a pessimist, you're either a dedicated 100% short seller or you're just going to pull your hair out.
Yeah.
Even though I don't have any hair, I haven't spent my career pulling my hair out. I've been mostly an optimist, and you kind of have to be an optimist. Look, if you look at Federal Reserve flow of funds data. U.S. is performing well.
Yeah.
It's a place where people feel confident putting their money in our equity
Absolutely.
markets.
Yeah.
So I think there's, they always say demographics is destiny, but I once heard Henry Kissinger speak, and he said, judge a country, not by the headlines, but by our people leaving other countries to immigrate there.
Right.
Right, judge the strength of a country by that metric, and by that metric, the U.S. is probably still the destination, number one destination for people and capital.
Right.
So,
well, last question on the market here is around concentration. So, in the public markets, the market has gotten much more concentrated, likely than it's ever been. I guess depending on how you measure that, and when you look at the S&P 500 as an example. Do you think that that's an issue? Do you think that that's an opportunity? Do you think that there's anything wrong with this? Is this just the natural order of business, or what are your thoughts there?
As fiduciaries, it's constantly on our mind.
Yeah.
Right. The last time we saw a huge run up in concentration in the S&P 500, if you look at the weight of the top 10 stocks, it was that .com bubble.
Right.
Where I think, late 90s, you saw the weight of the top 10 stocks in the S&P 500 go from mid-teens, high teens, 98 by 2000, it was in the, kind of high 20% range. And then, those vaunted names that no longer exist. And I can mention Sun Microsystems, Lucent, these are the companies you had to own, and they don't exist, and the whole, we saw that correction. Well, now we sit here at the end of last quarter, with the top 10 names in the S&P 500 accounting for over a third of the weight, right? The other 490 stocks be damned.
Right.
And so it does beg some question from a fiduciary standpoint about, diversification, because, if you look at all the legal, kind of framework, if it's the restatement of trusts, if it's, prudent investor rule, Uniform Prudent Investment Management of Institutional Funds Act, MIFA, all these different tools, codifications, and laws around how fiduciaries should handle money.
Right.
Preach diversification. It hasn't worked.
Yeah.
Right. And it's not working. And one might say, indexing, just the big companies get bigger. I talk about, 1987, reading Burton Malkiel's Random Walk Down Wall Street. But remember, he wrote that in 73.
Yeah.
He essentially predicted in 73 the index craze.
Yeah.
Right.
And this sort of flow of funds into that.
Okay. It does beg the question of where is the price discovery? Because there is no price discovery in an index. If everyone's indexing,
right? Exactly.
If everyone's indexing, everyone gets the same. There's no differentiation. So I think short sellers and fundamental research play a part in that price discovery, and there's less and less of that, which it begs the question. Okay, where is the price discovery happening?
And the follow-up question there is, does that make active management for those who are willing to tackle this and do the work, as you mentioned, more attractive?
I think they're both different ways to, it's multiple ways to slice the pie.
Yeah.
Right. And I think, active management is valuable. Passive investing is cheap, and it's an easy way for people to get broad market exposure. I've created equity indices, so I've lived in both worlds. Yeah. But I think too much of a good thing is still too much.
Yeah.
And so time will tell. But I think you need to look at both. But the concentration of the S&P 500 clearly, and of the Nasdaq and of the large indices, it does beg some questions about. Okay, are we diversified?
Right.
And the answer is maybe not.
Right. Not as much as we thought. Especially.
Not as much as we thought.
Yeah. That's an important question to consider and think about. Now we're going to move on. So the next segment here, just want to touch on, you're giving a guest lecture today. Thank you for doing that. You've been doing that regularly for years now. You're on the GW Investment Institute Advisory Board. Thank you for serving on that body. We're very appreciative. Could you maybe talk about some of the life lessons learned that you give to students when you're giving a guest lecture? So, when they're thinking about, okay, I'm here in class, I'm listening to a seasoned person from the, Wall Street business world, what kind of advice are you giving our students?
Sure. I mentioned my first tip, right? Robert's 5 tips, make your bosses look better.
Yeah.
Conventional wisdom of the crowd is often wrong.
Yeah.
And so, it's okay to think outside the box. One of my chief investment officers once said, we want to find young analysts who are very curious.
Yeah.
Right. I want to find curious people because I think curiosity is an important trait. You want to learn, you want to sponge for information.
Yeah.
But it's okay to challenge that popular narrative. I think years ago, Merrill Lynch back in the 70s, 80s, they had commercials with all these bulls running, and it was like, don't run with a crowd,
right?
Do something a little different. And it might have been Merrill, I can't remember. But they're just the bulls. And so, it's okay to challenge that conventional wisdom. Now, with the caveat, I think it was John Maynard Keynes once said, markets can remain irrational far longer than you can remain solvent.
Right.
So know who's on the other side of
that transaction.
That transaction. So that's another one, and I'm big on mentoring. I mentor at our firm. I've mentored, I've had some great mentors. So find a mentor early in your career, right? Really, there's no substitute for human-to-human interaction,
right.
Especially since we're all on screens. And it's just, find a mentor, someone you can have coffee with. And I preach this to my kids who are starting their careers. I preach it to kids in the to graduating seniors. But find a mentor. And conversely, if you're successful, then share that success. Pay it forward. Right? Give back, and become a mentor, right? What is the definition of mentorship? It's imparting wisdom.
Yeah.
Right. You're imparting hard-earned wisdom.
Yeah.
And some of the wisdom is very hard-earned.
Right. You paid high tuition for it.
Yeah.
In the market.
Yeah.
Sometimes.
You paid a high price for it. But and a lot of it is learned by failure.
Yeah.
And so let me don't make that same mistake I made.
Right.
Let me teach you something and learn something from my failures, so you don't have to. You'll have your own failures,
Right.
right? That's part of learning.
Right.
And then, lastly, everything will work out. So don't sweat the small stuff. It won't work out how you thought it would.
Yeah.
If I look at my career trajectory, it's it all worked out, not the way I thought it would when I was here back in the late 80s, right?
Right. Not predictable at that point. Yeah.
Yeah, not predictable. But it'll all work out. So try and enjoy the small things in life. You look, especially in our industry, people take themselves way too seriously.
Yeah.
Right. So lighten up a little bit, have a little fun, work hard. Yes, we I put in the 12, 15-hour days just like everyone else starting off, and that's what you got to do. And understand that, you're gonna benefit from all that work. And yes, it's like slave labor. I mean,
you're working a lot of hours.
You're working a lot of hours. You're taking the work home. You are logging a lot of hours. And when I started, there was no, these laptops didn't exist. And so you were in the office, 6 a.m. to 9 p.m., 10 p.m. It was, you're there a long time. But find time to relax, de-stress, have some outside passions, get some exercise, and just it'll all work out.
It'll all work out. Well, I think that's great parting wisdom. But is there anything else that you would like to say, or maybe a question that I should have asked you that I didn't ask to leave us with today?
I don't think so. I mean, look for some. I've told this to every class. It's a very competitive industry we live in and work in, but there are always little niche opportunities out there, and we manage a lot of municipal bonds for our clients, which tend to be either very high net worth institutions or their trust, or high net worth individuals, their trusts, and so municipal bonds, right? Double tax exempt income. Right, with a very, very low, not zero, but pretty close to a default rate. Yeah. Right. It's a corner of Wall Street, which is just kind of sleepy and no one, but necessary. Yeah. Right. That's how in this country
projects get done. Right.
It's how we finance a lot of schools and airports and
water infrastructure,
sewer, libraries, jails. Roads, and there will always be a demand for that product, right? And so instead of putting your career on the product du jour, right, and look at something that's
a little bit out of the way,
a little out of the way. Sometimes those are opportunities for young analysts and ones that maybe aren't as glamorous,
right? Could be even actually more attractive.
But could make for a long career.
Excellent. Well, I think that's great advice to end on. I want to say thank you, Mr. Roberts, for joining us today for Market News with Rodney Lake. My pleasure. And we look to have you back
absolutely
on another episode. So thank you very much. That's a wrap for Market News with Rodney Lake. We'll see you back next time. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.